you're going to spend $500,000 developing Charlie. You've got the PEA you mentioned. Are you going to move that PEA to a PFS or what's?
No, we're going to keep it a PEA. So the issue with creating a PFS or a feasibility study in the uranium space is that usually you have to tie it to a long-term contract. So, in order for us, which is always a challenge to get a contract, especially in the current environment. So, our aim is you can go forward into production just using a PEA, and I think that's our plan.
Right. So let's come back to G&A because I think and your strategy because I imagine they're intertwined. So your strategy, you've got a lot of optionality, 35 different assets. Okay, you're working out what's there, what's good, what's not, and that's taking a lot of time. I guess a lot of bought-in consultancy services. Is that 2.5? I mean, how does that break down? Is that a lot of bought-in costs around consultants to tell you what you have? Is that the problem?
Some of it is, but some of it is. Like for example, the share-based compensation those are options.
Yeah,
right? They're not shares, so there's not there's still a cash component that would have to come back into the company in order to get those shares.
Right.
We do have consultants in place because we have a very small team. Essentially, I'm here, and I have a part-time CFO.
Yeah.
So everybody else kind of comes in as necessary. So when it comes to some projects. When we're trying to close on, for example, the Cotter Corporation transaction, we need, external lawyers to come in to help us with, putting together definitive agreements, and things like that. So there are some costs associated with it, but it doesn't, the times when it ramps up are usually the times when we are looking to close a significant transaction.
Right, because it's talking about, 1.7, nearly 1.8 of the 2.5 on the G&A was consulting fees paid by the company. So is that all around the M&A type stuff or the deals? Yeah. Is that that's what you're saying? Okay.
Yeah. And I mean, we are basically an M&A company.
Yeah. Well, that's what I wanted to understand about your strategy. You are an M&A company. Are you an incubator? Are you saying we're never going to get into production here? It's the case. I need to find out what's good, and then maybe someone comes along and partners, JVs, whatever. What type of company are you? When investors are looking at you, what are they buying into?
Well, look, I think there are a couple of things. I think, our aim is to get into production. I think we've kind of gone a long way around trying to get to an asset that can get into production. We started off in 2015 buying the conventional assets from Uranium One.
Right.
The market at the time was actually much stronger than it is today. So I think everyone had the expectation that the market would continue to move north. And it didn't. So when we saw that the market was softening and realizing the differential between the cost of producing in an ISR environment versus a hard rock environment, we realized that it would take a very long time for us to get to the point where the hard rock assets are viable.
Right.
So that's when we started looking at ISR because that's the only place where in a nearer term, you get the opportunity to get into production. So we picked up the assets from Uranium One to start moving forward in that direction. Obviously, there's still a cost associated with trying to get those assets in production. We started looking around to see if there's anything that's closer to production status than what we had in our portfolio.
Right.
And Uranium One facilitated that process by introducing us to Cotter and saying, this would be a perfect asset given where it sits, given the cost to actually move material from this mine to the satellite plant and finally into the final processing plant, given its location, its proximity to our assets. So we started off with hard rock, high cost, and we moved the way down into ISR, near-term production. So we've kind of gone backwards.
So, but you said at the beginning we're an M&A company, and I think that's what you are today. That's, it is what you are today.
Absolutely. Look, we're in a low price environment and there are assets for sale. Yeah. In a high price environment, we probably wouldn't have been able to buy any of this.
Right. So so people are buying into your ability to do deals or identify deals which potentially have value, and for you to very quickly and cheaply discount the ones which perhaps don't meet the required levels that you're seeking. And for you then to be able to develop those and get into production at some point. And you're with the mill, you're looking at being able to have an infrastructure to look at that whole chain, right?
Correct.
Okay, so I just wanted to understand what you were today. That's all. That's all. Okay. One thing that stood out for it: investor relations, $500,000 last year. What were you promoting? Because it's like that's a lot of relations.
It is.
What was
We've
going
got a lot
on?
of assets. We have a lot to talk about.
Right.
We've got vanadium to talk about. We've
Right.
got ISR. We've got hard rock. We've got a lot of different things that we can focus on, and depending on where the market is,
Right.
we've put out news releases on vanadium because our Utah assets have vanadium in them. Now we've got Colorado, which has significant uranium. So we've got different ways to kind of skin the cat. So depending where the market is at the time, we will spend our time focusing on one area or another.
But if you're doing, I mean, so that's the thing. I'm intrigued with the junior company mentality. So I'm looking to you for help here. Is you've not got a lot of cash. You've got a skill set. You're positioning. You're M&A. You told me you're M&A. You've got a lot of optionality, but you must know what's going to work, not what's not going to work. I mean, for instance, spending time in vanadium and the environment which vanadium sat at, certainly the last half of last year, that wasn't necessarily where I would have thought you should spend your time talking to people about. So when you're doing investor relations, what does that involve? Are you traveling the world to have conversations with institutional investors, or what's it actually mean?
Yeah, look, we do spend a lot of time traveling and meeting with investors because it's the interesting thing about uranium space is that it's more about education at this point.
Right.
It's not a well-known space. A little bit of knowledge sometimes. It's a lot of the knowledge. When people have very little knowledge, it's usually pretty negative, or at least the perception is negative. So we're spending a lot of our time trying to overcome that negativity and really explain, why is this space actually important? And it's not all Chernobyl. It's actually, they're real viable businesses which have run for a long time, and there's been no risk in terms of
but that's not your job. There's some big guys with some big pockets, and we've spoken to a few recently. They got tens of millions in their back pocket. Isn't that their job? You don't need to do that, do you?
But it's their job. You still have to educate because not everybody's going to be in the same. Not everyone gets access to Cameco, right? So they need to understand from smaller companies. They can get a lot more information from us than they can get from Tim Ritzel over at Cameco. They don't have access.
Right.
To Tim Ritzel.
Right. Okay.
Right? You need to talk to others in the space to really get a better understanding, and really be able to dig into what exactly you're trying to achieve here.
Okay. Well, let's finish off on in terms of the company bit. Where do you sit in the market? Where do you position yourself in the market when you're going and doing this world tour of leading institutions? Where are you positioning yourself, and why should new investors looking at you, watching this video today, why should they be looking at you versus the next guy?
Look, I think as I mentioned, we're probably the next company to get into production, assuming the uranium price moves in the direction that we all hope.
Right.
We've got an asset which has been coveted by not only us but other parties in the sector because of, first of all, its proximity to infrastructure, and the potential partnership with a significantly large producer in order to move that asset forward. So I think that is kind of key. The fact that we do have these relationships are very unique in the sector. Most of the juniors are kind of off on an island, but we've managed to build relationships to the point where we can collaborate not only on this asset but on other projects going forward. So I think that's very important. We have that path to production, which is near term. And look, that path to production has been validated by our conversations and meetings with utilities. Utilities are looking at us, especially before 232. Maybe the conversation might be a bit different now because 232 didn't quite go the way we'd hoped. But the conversations were very much about looking to secure pounds going forward from junior players, including us. And we were part of that package. So I think that's an important point too. We have a path to production that's been recognized by the ultimate buyers.
But don't the basic rules of mining still apply? You need to be able to mine, not just get into production. Just because it's uranium doesn't make it hallowed ground. It's the basic rules of mining apply. You've got to be able to mine commercially,
yes,
economically. The numbers need to stack up. Obviously, if I'm talking to someone in the Athabasca Basin, they're going to tell me they've got it made. whoever they are. The grades are high. Your grade's not so high, they're a lot lower. But you're looking, I guess, at the Uranium One guys and saying, well, there's a nice comp. They're either side of me.
Absolutely.
That gives me a sense of, for Charlie, where we sit. You're not there yet with your 24 assets plus 9 assets. You still got to work that out.
Sure.
Right? And right now, you're a finance guy running a company. Where's the technical team that's going to help you deliver this? Are they...
Well, if you look at my board, we have over 120 years of uranium experience. One of our board members actually did the feasibility study for Charlie, so is intimately familiar with the project. We have...
Who's that?
Steve Lunsford.
Okay. And you've also had... Oh, right. Yeah. So Steve, tell us about him.
So Steve Lunsford's he's a local Wyoming guy. He's been in the business for 40 years, worked for Cameco Resources, which had acquired Power Resources, which owned the asset in the past. So he is very familiar with Wyoming, familiar with ISR, intimately familiar with Charlie. So he's our go-to person on the asset.
And John Eckersley, who has just joined, he's been advising you prior to that, though.
He has been. So John has been he's an attorney.
Yeah.
He's worked with junior companies for a number of years and spent a lot of our times going through our contracts. Any kind of NDAs that we have to put together, things like that. He'll spend his time.
And does that inform us that there's going to be more M&A?
Well, you can you can interpret it that way. You could. I think that's probably a good way to look at it. Yes.
You just raised a bit of cash. We've spoken to a few new entrants into the marketplace, and there will be more. If the market goes the way you need it to and the way you want it to go, there will be new entrants into the marketplace. It's just, that's the way these things work. There'll be a lot of noise. You've got a little bit of a head start. Your nearest term production compared to the rest of the non-producers. But are you concerned about these new people coming into the marketplace and stealing your thunder? Are they going to be able?
Absolutely not.
No.
Absolutely not. No, I think, as I said, we've been able to pick up some pretty decent assets which have near-term opportunity. And our aim is not, we're just not here to promote. We're here to get into production. So, as I said, Charlie had a relationship with Uranium One. Having something in place moves us further ahead of a number of players in the sector. I think the Shearing Canyon mill, there won't be another mill built anytime soon. And obviously the refurbishment cost seems, sounds significant, but when you put it in the context of the cost to build a new mill and the time frame to build a new mill and getting over NIMBYism, not in my backyard, it's going to be a big challenge for anybody else to get a mill built. But I know that, I'm not sure if you're familiar that Western Uranium last year lost its license in Colorado. It had a licensed had an actual radioactive materials license, which the state pulled away. So it shows you how unique these things are and how tough it is to keep them. But the interesting thing about that one is that it wasn't tied to a facility. So to get a license on your own without a facility is going to be a challenge. So from our perspective, we're feeling very comfortable that we've got something of kind of unique value.
But aren't you going to have to do something quite big because you haven't got enough money to get into production yet? You're going to have to go and raise some money, okay? The assets, you're not quite sure what you're going to be able to do with these assets yet. And when you are sure, you're going to have to go and raise a stack of money, okay? So today, the bulk of the value of your market cap or enterprise value, whichever one you're going to look at, is the mill. And the license for that mill, to operate that mill, presumably, so that no one's giving you value for the the assets that you've got on the books today, right? Because they're not worth a lot.
Well, look, I think the way that we're even valued is actually the ISR Wyoming assets are getting value. I don't think we're getting any value for the mill.
You don't think you are?
Any value for conventional assets at all.
Okay.
No, we don't think we are. We think that anybody who's investing in our story today is focused on Wyoming. They're like, oh, it's interesting. What does it cost to get into production, conventional production?
Right.
$60. Well, where are we today? 25. Where's the term price? 35.
Yeah.
Zero there. So I think everything is kind of because everyone who's in production right now is actually in the ISR space. So the
I-
fact that we have assets in the ISR space is giving us some value.
But
If
it's,
we didn't have those ISR properties,
Mm.
I don't think we have a market cap where we are today. I think it'd be significantly lower.
well, it's kind of insignificant whether you're 13 million or 30 million. You know, you're no nearer production, and the spot market's doing what it's doing, and until contract comes on board, you may as well be worth zero. It's the same net effect, right?
Yeah.
But which is why it intrigues me about the mill intrigues me as a USP, as a differentiator for you. When things come good,
Sure.
you would expect to see a significant re-rate, not just because of the production or the potential economic assets, but because of what you can then do. So
Yes.
is that part of what you would argue to new people looking at you, that you've got a whole bunch of zero rated or zero valued assets, so therefore when the clock starts ticking, you're going to get more of an uplift than others? I mean how?
Absolutely.
Right.
Absolutely. You know, I think it's a significant differentiator because, you know, when the market does move in the direction that we all hope it does, we have an asset which is very unique in that sector, which we can turn on,
Right.
to give us £1 million plus more production.
Okay.
And I think that's.
And then you need to come up with a solution of, where do I get the money? How do I keep dilution down? You know, all of that good stuff, which, you know, finance guys, you know, go to bed thinking about.